In this session, we are going to discuss the fiscal and monetary policy. Fiscal and monetary policy is related with government. So we will have a look at what exactly is a fiscal policy and what is monetary policy and how they are being managed in the country and how this is having impact on various companies which are present in the country. So let's begin. These are some of the important points related to fiscal and monetary policy. First of all, as we know that fiscal and monetary policy both are related with the government of the country. And the government policies can have deep impact on the economy. Why? Because government takes on huge amount of debt and also is one of the biggest spenders in the economy. Government is borrowing huge amount of money so that it can fund its development projects. So it is spending huge amount of money. That's why it is known as the biggest spenders in an economy. So now we know that government policy is important from the perspective of an economy. Now let's have a look at what exactly is monetary policy. Monetary policy refers to policy of the government towards quantity of money and credit creation. So monetary policy is related with the amount of money that is in circulation in a country and also the amount of credit that is being given in the country. Now let me just explain it to you so that you can understand it better. When we talk about credit creation, what is the meaning of credit creation? Credit creation means when a bank gives the money it has received from its depositors to other individuals and other companies in form of a loan, that is known as credit creation. The bank is creating credit. They are giving the money which it has received as deposits to the people who want to borrow money from bank. So monetary policy is in a way related to the various interest rates which are present in the economy, right? Interest rates like we have bank rate, which is one of the most important interest rate in the economy. So we're going to have a brief look at bank rate as well later on. But for now, please remember that monetary policy is related to the interest rates present in the economy. At which rate you can borrow from bank, that is the interest rate. Then we have fiscal policy. Fiscal policy is related to the policy of charging taxes and how the money which is being collected after charging taxes has been spent. That is the spending. So the fiscal policy is basically related with the tax rates of the country. What are the various tax rates? For example, what is the tax rate on salary of an individual? What is the tax rate on profits earned by a company? These all the tax rates are decided by the government, and the policy of tax rates comes under fiscal policy. So in fiscal policy, what the government basically is doing is they are deciding, let's say that someone who has income of more than 5 lakh rupees per annum has to pay 10% tax. Or a company which is making more than 100 crore rupees of net profit is supposed to pay 25% tax. So these all are 10% and 25% are the tax rates, right? So in fiscal policy, government decides the tax rates that it has to charge, and then it decides the money which is being collected by charging taxes, how they are going to spend that money, how much of that money they are going to spend on defense, how much of that money they are going to spend in healthcare, how much of that money they are going to spend on education. So government at one end is deciding the tax rates, and on another end is deciding where they are going to spend this money. So this is basically what is the fiscal policy. Now, both these policies, the monetary policy and the fiscal policy, can be used to promote economic development when the economy slows down, right? So, when we can say that the economy is slowing down, when the gross domestic product, which is also known as the GDP, its growth rate, the rate at which it is growing every year, slows down. That is an indicator that our economy is also slowing down. So whenever there is a fall in the GDP growth rate, we say that that particular country's economy is slowing down. So whenever a economy slows down, what happens? First problem is the rate of unemployment increases. A lot of people lose their job, and all the people who are getting educated do not get job opportunities because the economy has slowed down. So the biggest problem with slowing down of an economy is unemployment. Then if the economy is slowing down, there is a fall in living standards, how people live in that country. There is a fall in their living standard as well. So, of course, no government wants that there should be unemployment. No government wants that there should be fall in living standards of citizens of his country. So they have to ensure that the economy keeps on growing. So whenever there is a slowdown in the economy, the government can use fiscal policy and monetary policy to get the economy back on track, to make the economy grow again. So what is the basic idea behind fiscal policy and monetary policy? The idea is to promote the growth rate of the country and also to reduce unemployment. Now, every company, what they want is that the economy of the country should keep on growing at a stable rate, and there should be extremely low level of unemployment. That scenario is best for the companies which are operating in any country. So now let's first of all discuss in detail about the monetary policy. So as you know now that monetary policy is related to the interest rates in the economy. And the most important objective of monetary policy is to ensure price stability. Price stability is very important. What is the meaning of price stability? The price of various products being used by companies and individuals is not volatile, right? By volatile, I mean there is lot of fluctuation in the price. There is lot of fluctuation in the price. The prices are not stable like a straight line, right? So that is the objective of monetary policy, is to ensure that the prices of various products in the economy are stable. They are not very volatile. For example, let's have a look at US Federal Reserve. US Federal Reserve is just like what RBI is to India, Reserve Bank of India, which is the Central Bank of India, right? In the same way, like RBI is the Central Bank of India, US Federal Reserve is the Central Bank of USA. And what is the objective of the monetary policy of US Federal Reserve? They say the Federal Reserve sets the nation's monetary policy to promote the objective of maximum employment. That means maximum people of the country should have employment, prices should be stable, and moderate long-term interest rates. That the interest rates are not very high in the country. Now, if we talk about the Indian monetary policy, what is the main objective of Indian monetary policy? The RBI says that it will manage and formulate the Indian monetary policy keeping in view the price stability and objective of growth. So they will try to manage the prices of the country. They should be stable with keeping in mind that the country should keep on growing in economic terms. And as we know that Indian monetary policy is being decided by the Reserve Bank of India. Now, what exactly Reserve Bank of India does is, Reserve Bank of India continually on regular basis hold meetings to review the economic condition of the country. They look at what is the GDP growth rate of the country is. They look at what is the inflation rate. They look at the unemployment rate. So the RBI holds meeting and they have a look at the GDP growth rate, the inflation rate, and the unemployment rate. And on the basis of that, they decide what will be various type of interests which are present in the economy. Now, when I say interest, what is the meaning of interest? What kind of interest rate am I talking about here? The first interest rate which we should know is the bank rate. Bank rate is the rate at which Reserve Bank of India give loans to private and public banks of India. The rate of interest at which Reserve Bank of India give loans to private and public banks in India. So RBI can decide the bank rate, which is one of the major interest rates in the country. And the interest rates which are being decided in these meetings held by Reserve Bank of India, they are watched very closely by the financial markets. By financial markets, I mean, for example, the stock market. The participants in the stock market keep a very close view on the interest rate that is being decided by the Reserve Bank of India. The bank rate, which is being decided by the Reserve Bank of India. We have also discussed a little bit about inflation. Inflation is one of the major indicators of an economy, and by inflation we mean the rate at which prices of goods and services are rising in a country. So let's say inflation rate is 6%. What does it mean? It means that the product which was available for 100 rupees 1 year before is now available at 106 rupees. It has increased by 6%. So 6% is the rate at which prices of goods and services are increasing in the country. Now, some inflation rate, like for example 4% or 5%, inflation rate is assumed to be healthy for the country. A lot of research has been done, and they say that if the inflation in the country is at 4% or 5%, that is fine. There is no problem. So this rate of 4 to 5% is the expected inflation. The problem arises when the country experiences unexpected inflation. For example, inflation rate of 8%, inflation rate of 10%, which is very high. It is not good for the economy. Why? Because the income level, the income level of the citizens of the country remains the same, but prices of goods and services keeps on increasing. So now, due to increase in price of goods and services, the purchasing power of individuals, the citizens of the country, reduce. They cannot purchase the products and services they could have purchased earlier on. Now it is too expensive for them. Their income has not increased, but the price of goods and services have increased. So they cannot afford those goods and services now. So what happens is it leads to a fall in living standards. People are not able to buy the products and services that they want. So they will be lowering down their living standards. So whenever the actual inflation, the inflation that is being experienced by the country is more or less than the expected inflation, this leads to problem in the economy. Right? For example, if expected inflation is 4% or 5%, but actual inflation is 8% or 10%, then there will be problem in that economy. So what happens when the inflation rate is very high? When the inflation is high or very volatile, the lenders can ask for a higher interest rates, which can raise the borrowing cost of firms. So whenever the inflation rate is high in any country, what happens is the banks ask for a high rate of interest on its loan. A bank may be giving loans, let's say at 12% to firms. It is saying that if you want money, you can take from us. We will give you loan at 12% per annum. But due to high inflation, this interest rate increases, let's say to 16% now. Now all the firms which wanted to take loan at 12%, but they now find out that the interest rate has increased to 16%. a lot of firms will then not take the loan because they know they have to pay interest on that. And 16% is a very high interest rates. So the companies which wanted to take loan will not take loan at such high rate of interest because they know it will be very difficult to repay that loan, to pay the principal and the interest amount on that loan back to the bank. So what do firms do? They do not take the loan. They do not expand their business. If they don't take loan, then they will not have money to expand their business, right? So the firms are not able to grow when the interest rate in the country is high because the borrowing cost has increased. As mentioned in this point, high borrowing cost leads to slowdown in the economy. When the interest rate increases, firms do not take loan. When they do not take loan, they do not expand their business. And when the business does not expand, there is undoubtedly a slowdown in the economy. So it is not just that extremely high interest rates can cause slowdown in the economy. When the inflation is very volatile, that means the inflation rate is continuously fluctuating. It can lead to managers of various companies to believe that demand of their product has increased. So what will the managers do? When the managers will think that demand for their product has increased, they will increase the production capacity of the company. They will purchase new machinery. They will hire more labor. They will uh, build new factories to increase their production because they feel that the demand of their product has increased in the market. But that is not the truth, right? Because they are believing that the demand of their product has increased in the market, but it is all due to the volatile inflation. The demand has not increased. So what will happen? For example, ABC Limited increases its production by 10,000 units. Let's say ABC Limited is manufacturing smartphones and it believes that due to volatile inflation, they mistakenly think that the demand for their smartphone has increased. So what they will do is they will start manufacturing 10,000 more smartphones. But, but the demand for their smartphones has not increased. So what they will do? This 10,000 units of smartphones will be unsold. They won't be able to sell it, which is very bad news for the company because they have spent their money in manufacturing the smartphone, but they are not getting any sales out of it. So to sum up, when we talk about inflation, inflation should not be very high and it should not be very volatile. Because if the inflation rate is very high, then what happens is to control that inflation, the interest rates are also hiked. And when the interest rate is hiked, the companies do not take loan from banks, and that leads to a slowdown in the economy. So in the past 2 to 3 decades, a lot of economists are now believing and they are stating that this unexpected inflation, the inflation which is more than the expected inflation, it can lead to a lot of unemployment and fall in investment and profits. Now let us look at the various monetary policy tools. The tools. Now, let us discuss the various monetary policy tools which a country has, which it can use to control the amount of credit in the economy. First and foremost popular monetary policy tool is open market operations. What is the meaning of open market operation? It means buying and selling government bonds to commercial banks. So either we are buying or we are selling the government bonds to the commercial banks. So when the bonds are sold to commercial bank, their loan giving capacity decreases. Let me explain how does it happen. Let's suppose State Bank of India has 10,000 crore rupees of deposit with it. Now, if we just take it in a very simple manner, we can say that State Bank of India, since it has 10,000 crore rupees with it, it can give the entire 10,000 crore rupees as loan. Right? Now, whenever the government bonds are sold to commercial banks, let's say State Bank of India got the offer from Reserve Bank of India that it can buy 2,000 crore rupees of government bonds, and State Bank of India goes ahead and buys the 2,000 crore rupees government bond. So now what is the total amount of deposits left with State Bank of India? It is 8,000 crore. Now State Bank of India can only use this 8,000 crore to give loans, which was earlier 10,000 crore. So the credit generating capacity of State Bank of India has reduced. Earlier it was 10,000 crore. Now it is 8,000 crore. And this is happening because they have purchased 2,000 crore rupees of government bonds. So that was the first monetary policy tool, which is known as open market operations. Let's look at the second monetary policy tools. It is central bank's policy rates. So the central bank of our country is RBI, Reserve Bank of India. What they will do, they will increase the bank rate. When they will increase the bank rate? When they feel that inflation is very high. Whenever the inflation is high, usually Reserve Bank of India will increase the bank rate. And what is the bank rate? Bank rate is actually the rate of interest at which banks can borrow money from Reserve Bank of India. So if Reserve Bank of India is going to give loans to banks at a very high bank rate, then banks are going to give loan to its customers at a very high interest rate as well. So what will happen? The individuals and the companies will not take the loan because they will feel that the interest rate is very high. So what essentially is happening is, there is a fall in credit demand. The demand for loan has fallen because the interest rates are too high. Then the third monetary policy tool which Reserve Bank of India has is the reserve requirements. And these reserve requirements are basically related to CRR, which is the cash reserve ratio, and SLR, which is the statutory liquidity ratio. Now let me explain what exactly is CRR and SLR. Let's first of all take CRR, which is the cash reserve ratio. Cash reserve ratio is the percentage of total deposits with a bank which it has to keep with it in cash. So if a bank has rupees 100 deposit, and if CRR is 5%, what does it mean? Out of these 100 rupees, rupees 5 has to be kept with the bank in cash. They cannot give this rupees 5 as loan to any customer. They have to maintain this cash with themselves. And when we talk about SLR, which is the statutory liquidity ratio, it means the percentage of money out of total deposits which the bank has to maintain in government approved securities. So if a bank has 100 rupees of deposit, and let's say that statutory liquidity ratio is 25%. What does this mean? This means that out of the 100 rupees, rupees 25 has to be used to purchase government approved securities. So it's obvious that this 25 rupees cannot be given as loan to the loan applicants. So we see that cash reserve ratio is mandatory, and the bank has to maintain the cash in the proportion of cash reserve ratio, and they also have to maintain the required percentage of total deposits being invested in the government securities. So out of 100 rupees, 5 rupees is in cash, that is the cash reserve ratio, and 25 rupees, that is in SLR, statutory liquidity ratio. Rest of the money, rupees 70, can be given as loan by bank to its customer, but they cannot give this 30 rupees to loan in form of loan to its customers, because it is mandated by RBI that they have to maintain 5 rupees in cash and 25 rupees to invest in government approved securities. Now let's talk about why there is so much of talk about interest rates and inflation whenever we are talking about the stock market. Whenever you will switch on a news channel which is giving information about stock market, it will always talk about the interest rates, and it will always talk about the inflation in the country. So let's understand what is the impact of interest rate and inflation. What is the kind of impact interest rate and inflation has on the stock market? So as we know, whenever the inflation is above the comfort level of Reserve Bank of India, Whenever the inflation rate is more than the target rate of inflation, which is determined by the Reserve Bank of India, what the RBI does is it hikes the interest rate. It will increase the interest rate. And how it will increase the interest rate? It will increase the bank rate. Now, when the interest rates are increased, what will happen? The investors who were investing in stock market, now they will see that all of a sudden the interest rate on bank deposits have also increased. So whenever the bank rate is increased by the Reserve Bank of India, the loan interest rate increases and also the deposit interest rate increases. So when there will be an increase in the deposit interest rates, what people will do? They will not invest their money in stock market. What they will do? They will take the money out of the stock market and now they will deposit this money into banks in form of deposits. So over here we can clearly see that whenever the interest rates are hiked, money is being taken out of the stock market and is being put into banks. So that is the first impact on the stock market. The second way interest rate impact on the stock market is a bit indirect in nature, but let us understand how does it work out. Whenever the interest rates are increased, the companies which wanted to expand their business by taking a loan from a bank will not now take a loan because the interest rate is too high. So what they're going to do? They are going to say, okay, the interest rate is too high right now, so let's not expand the business. Let's wait for the interest rate to fall. Only then we will take loan and then we will invest their money in expanding our business. So now the companies are not growing. So what will happen? The stock market will be negatively impacted due to that. The sales and profits of the companies are not increasing. So it will obviously will not have a positive impact. Rather, it will have a negative impact on the stock market. So overall, when we talk about interest rate, a high interest rate can lead to slowdown in the economy. And whenever the economy will slow down, there will be a negative impact on the stock market. The level of stock market will fall and investors who have invested their money in the stock market will lose their money. Now, in today's scenario where we see there is so much of interdependence between countries, so it is not just when the Reserve Bank of India will change the interest rate that will have an impact on India. Even when the United States of America, US Federal Reserve, increases the interest rates, that will also have an impact on the Indian stock market. How? We know that lot of individuals, wealthy individuals and large companies of United States of America put their money, they invest their money in the Indian stock market. Now, why they are taking the money out of their country and investing this money in Indian stock market? Because the rate of interest, the amount of return that a USA company or a USA citizen can earn in USA is much lower than what they can earn in the stock markets of our country. So why they are putting their money into our country, why they are investing their money into the stock markets of India in expectation of high return, because they cannot get that high rate of return in their own country. But when the interest rate in United States of America will increase, the wealthy individual and companies which were investing in the Indian stock market will now take the money out of the Indian stock market and will deposit it in banks of United States of America. Why? Because now they are getting very good interest rates in the USA, right? So they will take the money out of Indian stock market. So now we see how interest rate even in a foreign country can impact the stock market of our country. So now we have a basic understanding of the monetary policy. So now let's have a look at two types of monetary policy. First one is the expansionary policy and second is the contractionary policy. Both are types of monetary policy. Now in the first type, which is the expansionary monetary policy, the government, what they will do is through RBI, they will reduce the interest rate. They will reduce the interest rates. So what will happen? Now banks of India will reduce the interest rate. So the retail customer means any customer with the bank which is there to take a loan, let's suppose a home loan, a personal loan or a car loan, and also the corporate customer. Corporate customer is the companies. They both, the retail customer and the corporate customer, they both will now take more loan from bank because the interest rate has reduced. So now the companies can take loan from bank and expand their business, and retail customers can take loan from bank and build a home. They can buy a car, they can buy electronic products. So what will happen? The demand for finished product of various companies in the country will increase because retail customer is now taking loan and purchasing various products of the companies. So we now see how does an expansionary policy, which is reduction in the interest rates, leading to more economic activity in the country. If companies go to bank and take a lot of loan, and let's suppose they build a new factory, they launch a new product, this all will lead to increase in the economic activity within the country. In the same way, if retail customers, people like you and me, will go to bank and take a home loan, take a car loan, and we purchase a home, we buy a car by taking that loan. This will also lead to increase in the economic activity of the country. So whenever there will be an increase in the economic activity of the country, then the economy of the country will expand, it will grow. So how does the RBI is following the expansionary policy? It is reducing the key interest rates present in the economy, like bank rate, like repo rate, and like reverse repo rate.